Hi, everybody. Welcome
Yeah.
to the CRE Syndicate, where we discuss commercial real estate and today's news. CRE Syndicate is sponsored by Pre-iShare as well as Family Office Insights. I'm Julie Tallman with Pre-iShare, and I'm joined today with gentlemen that you'll meet here very soon. Christian Sadler is Pre-iShare's VP of Investor Relations. Arthur Bavelis is the founder of Family Office Insights. And I want to give you a little bit of background on our guest for today. But first, Sebastian, if you just say hello so the audience can see your face.
Sure. Hi, everyone.
There you go. Sebastian Post is managing director and co-head of investments for fund management platform Lionheart Strategic Management. And Sebastian he's been able to contribute to the long legacy of the Fisher Brothers family, started with them in 2011. So Sebastian has been involved in the execution of over 2 billion in equity investments and over 50 billion in real estate investments. So welcome, Sebastian. Thanks for just taking time to chat with us today.
No problem. Thanks for having me on.
Right. Beautiful. Christian, Arthur, Sebastian, let's get started, gentlemen.
All right, let's jump
take it away. Yeah.
Absolutely. And I think we should start with the shakeup, as we always do. So I saw an interesting article, and we will link it in the description if you're seeing this on a social platform. So essentially what it's saying is that the S&P Global Ratings have downgraded 5 smaller banks that have exposure to commercial real estate. They've been downgraded from, let me see if I can find that, from stable to negative. And they're saying that a lot of that is just based on the fact that they have a substantial amount of their holdings or lending in the commercial real estate space. I think it's 25 to 55% of their lending is in that space, and that's where they have downgraded them. What I thought was interesting about the article is it also says that these banks have not had any uptick in defaults, and in fact have been very conservative in the way that they've underwritten this debt. So, I look at this and I'm curious, Sebastian, I pulled this article specifically because of your background and how you could chime in on some of this because you're in this space. But I'm curious how this will affect some of these banks. We always get afraid that maybe there's a run on the bank if we're banking with any of these folks in that scenario. And I also think about it from almost like a personal perspective of, I've seen many people where maybe somebody, the credit rating agencies will put something that is not theirs on their credit, and all of a sudden, it affects their entire life with their financial situation because their credit goes down. And I wonder if this could be a similar scenario where, they downgrade their rating, and now it affects these banks negatively. Arthur, Sebastian, I'd love your thoughts on it.
Oh, go ahead, Sebastian. I have some thoughts, which is not rare, but go ahead.
Sure, happy to speak about them. So I think there was 5 banks mentioned. I saw the article actually earlier this morning as well. We're not counterparties to any of those banks, so I'm kind of speaking outside of complete knowledge of their books. It will definitely have an effect. I mean, I think you saw it pretty clearly in March of 23 when all the regional banks were having the volatility. They kind of went out of the marketplace. And effectively, most of them are still out of the marketplace. Some of them have come back in Q1 of this year, but more or less, they're not as active and probably won't be as active for a while due to their over allocation of commercial real estate. Now, surprising that none of them had any issues. I can't tell if that's because the loans are modified and there is no defaults as long as those agreements are in place with their borrowers. But I think for them, these banks will probably just continue to be out of the marketplace for as long as they can be, and have increased capital ratios on their end for as long as the Fed, thinks that there's issues at those banks.
What do you think about, guys, and Julie? I think there's a level of hedging for the rating agencies, especially if they get called to the mat again and there's huge defaults and they didn't downgrade some of the financial institutions like they didn't do in 2008, for example. They didn't see it coming. And I'm not saying they don't have good reasons for downgrading these financial institutions, but how much of it do you think it's just optics of just protecting their rating agency against getting called out if something actually does happen?
Yeah, I mean, I think that that's an interesting thought. I believe that, you know, the whole world became more conservative in a lot of sense after the 2008 downturn, and you know, banking laws obviously changed completely. But I think a lot of people try to save face now to not to speak too highly when there's potential for these defaults. Now, one of the things they did mention is, you know, one of the key factors is how much office was included in their portfolio. And we all know that there's a lot of fear in the office commercial real estate space. So, you know, there's definitely merit to some of that. But like you said, what happens if they are just trying to get ahead of the curve to save their own face, and it hurts these banking institutions? And also, you know, I think about it from talking with real estate sponsors every day. You know, they're having a tough time knowing which banks to go to, and these are some of these names I've heard from syndicators that these are the ones who are very favorable, you know, to somebody who's raising capital and putting together an investment portfolio. So now if they have less options to go to, how does that affect the overall market, as you know, in that realm?
I mean, there's definitely less liquidity in the marketplace, and the regional banks are the primary drivers of a lot of those deals the last 10 years, right? So they're not there today. So that's why private capital is kind of opening itself up to be where it is today. There's a lot of money in the private capital space, kind of trying to fill the void of the banks that are no longer there.
Yeah, the private debt, right? I think Valley National is New York based.
That's right.
And at one time, they had one of the best balance sheets, credit default swaps, the whole thing, highly rated, and you know, well thought of for a very, very long time. Just trying to recollect that. And I also saw an article that's related that UBS came out and said that they didn't really explain it well, or I didn't understand it well, but they said there's been a reduction of just over 12% in lending for them in commercial real estate area. So, you know, we've all been suspect that commercial real estate will suffer. So maybe we're, you know, finally the numbers are catching up in some level to demonstrate that empirically. Have you seen it anywhere else, Sebastian? Or I mean, we know the liquidity is tight, but has there been an exacerbated amount of pullback in the last couple months?
For sure. Ever since March of last year. I mean, deals that we wouldn't be able to compete on, that we've just seen more in the last year, that regional banks would have just filled. The deals that are like sub $50 million and less, they're not there today. Like they basically can't lend, and they have to kind of shore up their own books. A lot of these banks just had over allocations to real estate, like M&T Bank, huge over allocation to real estate, kind of makes them out of the business more or less, unless it's like the best client of the bank type of thing. I think as long as rates stay up as where they're at, and the Fed's going to be cautious in terms of how banks are going to, you know, be able to do more business going forward, between higher borrowing costs and, you know, eventually there's a maturity date. I don't know how they're not going to be forcing them to sell or forcing them to take over properties, but they're definitely telling them to extend and pretend as long as they can.
And I know in that article, it actually said they've downgraded 18% of the commercial lenders that they rate. So, you know, it's not just these 5 regional banks. It's kind of.
Yeah, I know that it's New York's idiosyncratically different than a lot of other places, as are other major cities. I did read that and talk to a few folks that the Class A space, people are bidding it up from a commercial perspective for tenants, and then everything else is sort of floundering. Can you comment about that? as it relates to New York, Sebastian, at all?
Sorry, I had the fire alarm going off.
Uh-oh,
Sorry.
it's okay.
Don't need to
Just fine.
evacuate, do you?
No, it was a test. I don't know why.
Yeah.
Sorry, can you say that one more time?
No, no problem. Yeah. So I was talking to some folks and also listening to a few folks talk about that Class A space in commercial space for tenants in New York City. There's people clamoring to get those leases, but everything else below that is still suffering at some level or another. Is that what you've seen?
Spot on. Very
Yeah.
spot on. Yeah, I mean,
Yeah.
if you're a tenant or an office loaner on Park Avenue or in a brand new office building, like location still works. You'll get leased. I know the Fisher family I work for signed the largest office lease in the country last year. It was 800,000 square feet to Paul Weiss, Class A institutional building on 6th Avenue. But concessions are up, right? Concessions are probably 2x what they used to be pre-COVID. The stuff that's in Midtown South and some of these 1940s and 50s old buildings just can't pay anyone to take that space. It's kind of weird, very different than the world in 2019.
Yeah. Isn't Paul Weiss the speaking of current events, the law firm that Sam Bankman-Fried fired? And by the way,
I'm not sure.
they're a great law firm. I've used them. They're absolutely amazing. It's not to say that there was anything wrong with them, but there's I'm not surprised that they signed that lease. They are totally white shoe Tiffany, super good law firm.
Well, big lease too, 800,000 square feet. I mean,
Yeah.
not that many tenants can sign that big of a lease.
Yeah.
Well, it's funny. It's the world like in pre-COVID, like Midtown South was like the place to be with all these tenants, and like you walk around and like no one's taking that space today. All the
Yeah.
tech companies still are very not return to work type priorities. But the financial services, I mean, everyone's in the office 4 to 5 days a week. Back in New York, Midtown seems to be kind of booming again.
Yeah. One Vanderbilt filled up real fast too, right?
Yeah. Yeah.
Yes. Your neighbor there.
And RXR is hopefully eventually going up at the Grand Hyatt. That'll be I think 2 or 3 million square feet by itself. It's like a
Wow.
$6 billion project. Citadel's knocking down office buildings to build on Park Avenue. So tenants that really want to be here, and they're definitely going for it. I mean, JP Morgan, right? They knocked down a 60-story building to build back a 60-story building that's like twice the size.
Yeah. Yeah, it definitely, for the benefit of the audience, New York's a different animal in many, many ways, as I mentioned earlier, but it's encouraging to see that's happening in New York. It bodes well for the city, I think.
For sure. I mean, we walk around New York today, hotels are doing better than they were pre-COVID. Apartment, can't really build new apartment buildings going forward without the tax abatement program that expired. So rents will just keep going up because you can't really build new apartment buildings going forward. The only asset class that seems to struggle in New York right now is office. Eventually that'll get figured out. But good bets to make in New York today are hospitality and multifamily.
Yeah, and the private club business, Core Club opened up another club. Amman has a $4,000 a night hotel club in Midtown. It's crazy what's going on, and those are the people that pay the taxes, right?
Yeah. Yeah.
Have you gotten involved in the hospitality space at all on the private lending side?
We have. We financed a handful of assets. We did a down in Nashville, which was actually a home run of the deal for the sponsor. We were there as a lender. I think that was in 2018, got paid off in 2020, 21. That was a beautiful asset. It was a new flagship W for Marriott, kind of trying to rebrand the entire W flag. We also did the Moxie Lower East Side in Manhattan. We actually took a bet on that one in the summer of 21, when no one thought New York was going to come back, and You know, you look at it now, it was what a no-brainer. We got paid off on that transaction as well. And the sponsor's doing great.
Yeah, I know those folks. I had them in Family Office Insights, and I've been in that Moxie, and we did a reception there as well. And it's typical. It was just really entertaining what the model was, because you went into the room and it was, you know, just like a New York City apartment, you know, one room and everything's in there.
Yeah, that's a great brand. I mean, I think they have like 4 or 5 of them in the city now. And it's not about the hotel. It's like all about the food and beverage.
Totally.
People just love going there because they have Tao doing most of the food and beverage for the hotels.
Yeah.
Great restaurants, great nightlife scene, and the rooms are nothing special because they're
No,
just
it's a common
Yeah.
space is beautiful too. It's sexy, right?
Yeah.
Yeah,
yeah. Hats off to them. I mean, they did a great job with that entire brand.
totally.
So Sebastian, I would love to back up for those who don't, know who the Fisher brothers are, what that company means, and your role. Why don't you just give us the lowdown?
Sure.
What is it that that you guys do now, and where did you originate from?
Sure. So the Fisher family, for those that don't know, it's a 100-year-old real estate family, actually 108 now, started in 1915, predominantly Class A office landlords in New York and DC. New York, they own about 5 million square feet. In DC, they own about 2. Primarily, 1 million, 2 million square foot office deals on Park Avenue, 6th Avenue, 3rd Avenue, that have kind of built the wealth for the family. I've been with them since 2011. Given the large size of the family and how old they've been around for, they have lots of different businesses. And I started off in the development group, working on ground up development projects in New York and DC at the time. We built around $4 billion of assets, a lot of multifamily, some condo for sale. And then kind of uh, when the market was getting heated, we switched more to the credit space and launched our credit business in 2017. So I transitioned full time, kind of on the heels of COVID, became co-head of investments, and I run the fund management arm for the family today.
Can you talk about the Nevada thing at all?
Sure. So that is an assemblage that the family put together prior to my time. That they are now developing. It's about 80 acres just west of the Strip, north of, I guess, Desert Inn along I-15. It's anchored by a retail complex in the, I guess, the south of it, and then there's a couple of acres of land that are getting developed now. That was, I think, started construction in, I want to say, 17. It does great. It's anchored by a tenant called Meow Wolf, which I don't know if you guys have ever heard of, but brings in a lot of visitors. I think they get about 2 million visitors a year. And then their second phase is a project that's going to be anchored by, I think it's public. Want to make sure it's public.
Yeah, don't say it. Yes, err on the side of it's fine. Yeah,
it's under construction now. It's going to be anchored by a Fortune 500 company. So that's getting developed shortly. And then there's a couple more acres left to kind of develop as a third and fourth phase down the road.
I know a little bit about it, and what was interesting to me is how long and how patient the Fisher brother was to make that assemblage happen, right?
Yeah.
It was
Yeah,
a
it took a
long
long
time. Yeah.
I can't even imagine the development experience you've had working with them and looking at that legacy. What are your favorite markets and assets to invest in?
It kind of goes every couple of years somewhere different.
Yeah.
When I remember when I first started, like Washington, D.C. was the best city in the country for development. Everyone loved it. We did some development down there, worked great. Today, not so much, right? So it kind of ebbs and flows throughout the years. I want to say towards the end of like 2017 to 2019, it was definitely Nashville. A little bit in Miami, not that much. But those were like the growth cities that we all kind of liked. And then on the heels of COVID, it definitely became Miami again. Philadelphia actually was pretty big, and Nashville a little bit more. But Miami obviously took big brunt of all the deals, kind of in our second vehicle. And now it's kind of a retrenchment back to like the old guard cities where it's like a little bit more of New York, Boston, Chicago to an extent. You're seeing a lot of cities like in Austin, that was the hottest city 2 years ago. That's seeing 10% rent declines this year because there's too much supply hitting the marketplace. So we are not market timers, although we watch the macro trends. So we try to take a holistic view of kind of supply and kind of where that's going to hit the most, kind of avoid that or go in on a transaction that's a pretty low leverage point where we're pretty much safe at all times. But it is interesting now to kind of see like full life cycle. You're kind of coming back up to Northeast, just because of supply additions. There's not that much up here, and there's usually supply restrictions in a lot of these cities. So New York, Chicago, their tax abatement programs have expired that have been around for decades. That's only going to cause rents to go up. So as long as you could build, prior to the expiration of those tax payments, you should be in a good position 3, 4, 5 years from now.
And from a regulatory perspective, or it's seemingly highly unlikely that those will be renewed in some level, just because the state or the city needs the revenue.
Yeah, I mean, it's surprising because they're just tax abatements, right? So they're still collecting taxes on what they are today. They just won't get taxes of what the project should be when they're fully built.
Right.
Which is kind of like a catch-22. Like you're not going to have more residents. All you're doing is causing rents to go up. Tax revenue really doesn't go up. So I think you're personally hurting just renters in the marketplace, because they're just going to pay more in rent because there's no supply of new apartments hitting the marketplace. No, there's no new jobs building those buildings, right? It's just going to be, it's a compounding issue. And mostly because, at least specifically to New York, tax structure is kind of messed up for multifamily development. Taxes overburden the multifamily market more so than the for sale market by a good amount, which makes development of multifamily product very uneconomical. You're just going to be forcing to do condo developments that are unattainable for most average citizens.
I was just going to ask that, are they kind of, is New York kind of looking to hold out and see what happens with office, or what has the conversation been like in terms of converting those buildings and making them usable?
I mean, there's definitely legislation in the works to convert at least Midtown South to residential, much like what they did down in the World Financial Center, the financial district. That has turned out to be a great case. A lot of those big office buildings are 1 million square feet, get converted. People live in them. I lived in one of them when I first moved to New York, and I loved it. But you'll see more of that more in the Midtown South area as soon as that legislation kind of goes through. The issue is this generally tax abatements. Like the zoning could be in place, but without tax abatements, it's kind of hard to make the numbers still pencil. Now maybe values go down and that reflects it down the road, but I don't know if it's there yet today.
Do they end up being kind of loft-ish? And is that why you say they're not really financially attainable? Because it's that big space for the...
So 2 things. In New York, not every city's like this, but you have to have legal light and air to count as a bedroom, right? So you can't have interior bedrooms in New York. Just it's against the law. Eventually, someone should pass legislation to fix that. So that makes it challenging. And then B, like a lot of these buildings are very deep, right? So you really don't want to be more than 30 feet deep in an apartment layout to make an apartment work for the average consumer, right? Because then it just gets really dark towards the back. These big office buildings usually have that issue, and it's hard to kind of remedy that. It's funny, when I lived in one apartment building, I had a 900 square foot studio. That was like, it was the best thing in the whole world. It felt like a loft. But that only works when you're young and in your 20s.
And no kids or whatever, or partners. Right. My first apartment in New York City, if you don't mind me sharing the story, as I rented a loft type apartment, Julie, that was right at the entrance of the Holland Tunnel. You probably know the building, Sebastian. It was on Broome Street.
Sure.
And it was beautiful, roomy, tall ceilings, had a washer and dryer, which is a treat in New York, right? And the problem was that from 6 a.m. to 8 p.m., you couldn't hear or sleep anything, because no matter how many times you drove into New York through the Holland Tunnel, it was 2 hours of people leaning on the horn. I mean, it was unbearable. And then same thing between 5 and 7 p.m. People getting into the Holland Tunnel. It was, typical New York. We loved it, but it was still one of those things you don't think about until you're in there.
Yeah.
I can only imagine. I still remember the first night in New York, sleeping and then waking up and sleeping and waking up and think, the madness, the city,
The madness, right?
the real estate.
Yeah.
I relate
Now
some of
it's
what
just
you're
student
talking to. Really, some of what you're talking to Utah with, multifamily. I know that, in certain sectors, it's definitely less expensive right now to rent than it is to buy. And so you see, folks moving towards that rental space, but also we've had so many people come in and build multifamily that now they're offering more concessions and having, slower lease ups in these new construction. And you're actually seeing some of them, it seems to be stalling out or slowing down in their construction. And I wonder if that's strategic or if that is, a financial strain. Do you know anything about, maybe not specifically Utah, but what you're seeing across the board in multifamily?
So it's interesting thesis that we're kind of working around. So we're actually bullish on multifamily purely for that discount between home ownership and multifamily rents. I think it's been the widest it's ever been, given where underlying, rates are today at 5.5 for the short term and 4.5 for the 10-year. I think it's like a $1,400 square foot month delta between home ownership on average in the United States. So that begs the question, like, people should just be moving into multifamily buildings and they get leased up. The problem is, like, some cities are just overbuilt, like Austin, Miami, maybe eventually. So we're bullish on multifamily, and it just kind of depends on what marketplace, because I think tenants will be forced to stay in apartment buildings longer than they really want to, because homeownership is unattainable. I'm pretty positive that 80% of US homeowners have fixed mortgages that are like sub 3%. Like, they're not going to sell.
Yeah,
Like,
why would
they can't sell, right? And like in the Northeast, like, there's no supply up here. So it's just going to get worse and worse and worse, right? Some other markets less so, but it's really hard to achieve home ownership in today's rate environment. It's just almost impossible for some people.
So you talked about some of the markets, the key markets historically. What are you guys looking at over the next 1 to 2 years? Are there some markets you have your eyes on?
I think it's just more of a retrenchment back. There's not any kind of specific market that we like today outside of, actually, we like New York. We like Boston to an extent. It kind of just depends on the asset class as well. Chicago, I know people have two views on it. I think eventually Chicago does come back a little bit. Again, another market you can't really build multifamily in because the tax evasion program ran out. And if I was a real betting man, I'd probably say somewhere in California in the next 5 to 10 years, but that's probably a tougher risk to take. But I bet whoever buys in San Francisco and LA now is going to look pretty good in the next 5 to 10 years.
Well, and you're in the credit space primarily now, so you guys aren't focused on doing the development yourself. It sounds like, anyways. I don't want to speak for you, but with that, I know that banks are tightening up a lot of their criteria. Are you guys also making people have more equity in the game so that you're at a lower loan to value? And what are some of the other things that you're doing to hedge your risk as somebody in the credit space lending in real estate?
Sure. So yes, we're pulling back leverage pretty much kind of across the board. I mean, pre-rate rises, we were going up to 75% leverage on most transactions. Today, we're closer to 60. Just the math doesn't really work, just for takeout analysis. And I mean, we don't really lend to own. It's not really the business that we're in, but we're on average, 10% less in leverage proceeds than we were 2-3 years ago. And it just requires people to backfill with more equity or try to find pref equity to kind of fill the gap. structurally, we're not really a traditional recourse lender. We don't require people to put a principal recourse. Well, that is an option for us to kind of put if it's kind of take it or leave it type of scenario for us on the transaction. But we try to be prudent in terms of leverage levels. That's kind of the only lever that we really have to pull.
Which I think is actually good for the market overall, right? So if we have less leverage in the market, I mean, leverage is a double-edged sword. We all know that the reason that people invest in real estate is because the benefits that come from leverage, but also when things start changing the way that they have, then that double-edged sword can come back to bite you. So, I mean, I think there's a positive aspect to people having more equity in the game, so long as they're structured properly.
Yeah, problem is there's no equity.
Yeah.
So
Yeah.
a lot of deals just don't get built, right? They can't get built, or they have to give back the keys to the land lender because they can't get the financing in place. So we're seeing a lot of that.
Is it a fair question, jurisdiction by jurisdiction or city by city, to ask if the loan to value has gone from 70 to 60, has the valuation dropped 10%, 20%, 30% overall? In other words, if a building was worth 100 million, 3 years ago, is it now worth 80? And you're lending 70 against 80 instead of, 60 against 80 instead of 70 against 100?
Yeah, I mean, yes, right. I mean, so most of our lending, I would say 70% is construction lending. So we're lending against cost, although
Yeah.
we're obviously lending to value as well.
Yeah.
Majority of the time today, believe it or not, value is less than cost. So, I mean, that's not our problem because we're the lender, but hopefully the equity figures that out, or the world gets better in 2 or 3 years, and hopefully they didn't spend money that's not worth it on their end. But we see that more times than not. I mean, a lot of times I'm looking at transactions and the value is just not there. It's less than cost.
Value less than cost. That's scary, right?
That's terrifying.
Yeah.
Sebastian, what's your average deal size? I mean, you've talked about a lot of very large deals. So on a secondary question, when you're talking about some of those larger transactions, I mean, what's the timeline on something like that?
So our average equity invested, just kind of out of our funds, is between 50 and 50, kind of ballpark. So that, and we're usually as a mezzanine lender, so that is usually call a $75 million loan to 100 million, kind of on the small end, and then up to 250, 300 on the higher end. So our clientele are pretty institutional, just given no one's really doing their first deal at $100 million a pop. So that's been kind of our general focus. And to close a transaction, and today it probably takes 6+ months on a good day, just between everything's difficult.
Yeah.
Everything just takes time. Everyone wants to negotiate. There's no rush. Everyone's hoping that rates go down, so that way cost of financing goes down. But I don't know. I feel like rates will not drop as much as people think they will anytime soon. It's kind of my own personal guess.
Yeah, let's talk about that. Can you talk a little bit more about why you feel that way?
Yeah, I think it's just if I'm Jerome Powell and I see unemployment sub 4%, the stock market all-time highs, GDP at 3.4% as of today for the last quarter. Why?
What's the rush?
Yeah, like why? Inflation's still at 3%. He hasn't done his job, right? It has to go down to 2, according to him. I see no reason for him to drop rates.
Yeah.
I don't know. How do you guys feel?
Yeah. He kind
I'm
of made it clear in what he said recently, right? It won't be at the very least until late in the year.
yeah.
I think people were pricing in like 6 cuts so far this year, like at the end of last year, and maybe 1,
Not
maybe 2.
happening. Yep. Hope
No.
we pray for one the end of this year.
So where does this put people who their rate caps are going to be expiring, right? If they had rate caps, then they're going to be expiring. Are we going to see blood in the streets, or are we going to see a lot of these lenders that are going to make exceptions to their rules and extend out and offer concessions to the investors?
My bet is extend and pretend for as long as they can. I don't think the regulators are going to tell the banks to, tighten screws on anybody. unless the asset just is completely impaired from, it's an office building with no leases type of situation. But I think they're just going to keep extending and pretending for as long as they can. I don't think the banks really want to own these assets. And usually it's not really at the borrower's fault, right? No one predicted 500 basis points increase in rate rises. So like, it's kind of be hard to be mad at somebody for executing a business plan and then the world just changes on them.
Yeah.
But I think everyone's accepted that rates are going to be at this level, right? So either they could grow their way out with rent increases, or they get creative in some kind of fashion. And banks are just going to have to be, very reasonable in terms of just extending for as long as they can. I don't think anyone's I don't think anyone's increasing spreads on borrowers today just because, they're stuck in a deal. That I haven't seen.
I don't know how
Right.
this works, at least now. But if a bank extends and pretends, does it impair their regulatory capital when the comptroller of currency comes in and does the review and say you got too many extended pretends here?
I think it depends on the jurisdiction of what state it's in and what, I mean, I guess it ultimately rolls up to the OCC, and kind of depends on where the bank's located. I mean, we've had banks where you could do three modifications, but once you get to past 3 year, and it causes issues on our book.
Yeah.
So it kind of depends on which bank it is and which regulatory requirements it's kind of hitting up against. But yeah, I think after like 3 or 4 modifications, I think the regulators will kind of tell them to put more capital reserves against those losses. Again, I don't work inside of a bank, so I have no idea. I'm kind of just speculating here, but I think that's generally how the way it works.
Yeah, makes sense.
And with you guys being in that private, and mezzanine space, are your rates moving based on, the change in interest rates, or are you guys just static because that's the game that you play?
In normal markets, when underlying rates go up, spreads come in, right? And I've generally seen that. I mean, that's kind of what happened like 17 to 19. Kind of, it went from 0 to 2.5. Spreads kind of came in, 200 basis points, kind of worked itself out because there's a lot of liquidity in the marketplace. Today, I think some lenders may be dropping some spreads, but more or less we're kind of staying even. We still think that there's a lot less liquidity kind of in this space. So most of our spreads are the same spreads we had 2 years ago. And all the returns that we're up 500 basis points from then. So all the returns are, thankfully to Jerome Powell and his team.
Yeah. Yeah, you're not up 500 basis points on the spread. Your spread is consistent. It's just that, yeah, got it. Yeah.
And so with that being said, I mean, you're basing it off the spread, but if rates go down, do you see yourself lowering, or do you see yourself, essentially gaining additional spread in that case?
No, we have caps all built into our deals. So generally speaking, we're kind of protected to the downside on all of our transactions. Generally, I think they're around 4% on average, ranges from 4.5 to 3.5 type of thing. So all of our deals are protected on the downside. I don't know. I mean, I could see spreads coming in towards the end of the year, as more and more private capital kind of floods the space, because there seems to be a decent amount of capital being raised. You have hedge funds jumping into space now too because the yields are attractive. So it's time to, we'll see how it goes the next couple of months. But for now, I think we're holding steady. Problem is deal volumes are down, right? I think transaction volumes across the country are down like 70-80%, or at least they were last year. Just, people need to do transactions to make money. So it'd be interesting to see what happens kind of later on this year.
Yeah, it's
Have
almost
you
like
seen that? I'm sorry, Christian. Have you seen that corresponding reduction in stuff that you look at? Do you look at 70% less now?
No, surprisingly not. Like we track it like religiously. On average, last 3 years, our deal flow has been around 50 to 60 billion. And it's been that number every single year on average. We've kind of put out the same amount of money last couple of years. Pretty consistent about that as well. So I don't know, maybe we're just seeing more deals from more people, and I don't know, some other ones kind of went away, but it's been consistent. I haven't
I
seen a
happen,
big decline.
I happen to know what it is, so I'll share it with you since you
Sure.
asked and you didn't ask. Um, it's because you can close.
Yeah,
I mean, I mean, let's just face it. There's a lot of people that say they can close and they can't, right?
yeah, that's probably a good reason.
Yeah. I'm sorry, Christian, I interrupted you.
Oh, no, you're good. And I was going to ask, what you related to. Is it based on your track record? Is it based on the name that you have in the industry that people continue to come to you? Or is it just simply because you play in a different space than the typical bank?
Um, Good question. I don't know if I have a perfect answer, but I think it might be, I mean, the business really kind of took off in 2020. So maybe last year we should have saw $100 billion of deals, and it kind of went down back to 50 as we kind of keep scaling up our business. So maybe that is like the reason. Maybe we should have saw a lot more deals, historically speaking. But then I think it also helps that we've been out there. We have pretty big counterparties. We've been closing transactions for last couple of years, so people know we have capital and we can deploy it. So definitely get a fair share of deals from even your top, 5, 10 developers in the world. We get deal flow from pretty much everybody today, which really wasn't the case, earlier on. No one needed kind of our money in 2018. World's very different in 2024.
Yeah.
Capital scarce.
Yeah, when money's free and available, right? It's a different
Yeah.
business model, right?
Yeah, I don't see that changing anytime soon.
Yeah.
Well, and I think you nailed it, Arthur. If you're executing and you're able to close deals, people see that, and now you're having bigger players coming to you because they know that you've closed this other large transaction. I could see that continuing to grow. Help us understand the waterfall when you guys step into a deal. Are you guys behind a main lender, or how does that work? And when you're underwriting that, do you underwrite it as if you would buy out? Like it has to be good enough that you'd be willing to buy out the first in a worst case scenario?
Yes. So on average, we get about a third of our deal flow from banks that want to have an operator kind of in the back to their position and be in the mezz, just in case something bad does happen. So we have, I think, intercredit agreements with 12 other institutions that kind of come to us, and we share transactions on a weekly basis. We kind of underwrite together, we quote deals together. It's like one term sheet sometimes, it's seamless. When some of our biggest counterparties are your JP Morgans of the world, your Bank OZKs, who are large non-recourse lenders in the United States. So we have great relationships with those guys. And I mean, to the point where we're talking to those banks every single day about transaction. And we try to make it seamless for borrowers as well. Our intention is never to own something. I think we failed if we do. Yes, we want to be able to cure the senior, but I think in reality, what really happens is you, in your intercredit agreement, you negotiate time and money, right? How much little money do I have to put up so I could cure something, and how long of time period can I have to kind of cure that? That's usually the entire part of that agreement. So we have standing agreements with all these banks. They're pretty boilerplate at this point. Theoretically, yes. I mean, kind of depends on which bucket of capital we have the deal in, right? We could come and buy out the senior, and traditionally they'll probably just work with us, and as long as the project's okay and still rising or whatever it is, they'll work with us. Like they're not going to require us to buy out their loan, because they know that we're doing our job to help kind of cure whatever issues there are and help complete the project. When we look at deals, especially for construction, everyone's like, great, you guys can come in and fix something, if it's wrong. But by then it's always too late, right?
Yeah.
When you're trying to jump into a job and try to figure out who's been paid, who's not been paid. Sorry, got
Just
the
say that
again.
Just say that last sentence again. They'll edit it out perfectly.
Hold on, the fire alarm's going off.
Oh,
Again, I can't even hear it.
Yeah, we can't hear it on our end,
Oh, you
but
can't hear it?
it sounded like somebody was talking to you.
that's what I
No.
thought. Too. Yeah.
Sorry,
No
I don't know
problem.
why it decided to go off again.
I'm just glad it's your fire alarm and not my dog.
The dog would have been fine. Fire alarm's fine. I've had that, Sebastian, happen at least 4 or 5 times in New York City.
Yeah.
When
It's
I'm
funny. It never goes off. For some reason today
yeah,
it goes off at 6 o'clock on a
Only if
Thursday.
you're on
yeah,
camera.
right. Yeah.
I'll backtrack.
Yeah, what did you say?
So jumping into by the time you jump into a construction deal and there's an issue, trying to cure it is like the worst thing in the world because you got to pay people who haven't been paid. There's probably some defects happening in the entire construction job, and it's just too late, right? It's a lot of brain damage, and it takes up a lot of time for the entire organization. So where we try to pride ourselves is do all the work up front. If the GC they hire we don't like, we don't do the deal. We have pre-approval rights on all of them. We don't lend to borrowers that are also construction managers themselves because there's too much of a conflict of interest unless they actually do it for other third-party work or have a pretty deep track record of doing it. We think that's too much of a conflict. Additionally, we structure and kind of negotiate their GMP, not as much as like actually negotiating it, but we have our own general contractor council. We review all GMP contracts to make sure there's no issues. I mean, we've had deals where we made them replace a GC before we would close because we didn't like the deal and we thought they weren't able to build the building. So we tried to fix all those issues day one because we can't make a bad deal good, right?
Yeah. So you're coming from, I mean, luckily you guys were in that development space for so long. So now you don't have to be the operator. And it doesn't sound like you necessarily get involved in the day-to-day processes, but you underwrite and you'll actually suggest changes in order to get the deal closed, knowing that you don't want to have to deal with the problem later on.
Correct. Yeah. I mean, we make some people don't want to buy insurance, right? I've had that asked. They don't want to bond their subcontractors. And like we just say no. Just like either you do it or you find the money somewhere else. It's just life's too short.
So your
Yeah.
remedy would actually be working, and the bank would allow their debt to stay in place, and you would potentially step in as an operator. Is that what I'm understanding? Like you guys potentially would step in and take over a deal in a worst case scenario?
In a worst case scenario, yes. We're always pre-approved to do that. I mean, we have a services agreement with the Fisher organization. And they have obviously a full development team on staff. So we run deals by them on due diligence side just to get their thoughts on some items here and there. So we work very closely with them on a daily basis. So theoretically, if there's
Loving hearing about the efficiency of your business and your team. And I'm curious because you said you guys got a real uptick in business in 2020, which was COVID, when everybody else was just trying to hold a team together. What can you speak to why you had success in that era?
yeah, so it kind of seems like a blur. March of 20, I remember that hitting. I was in Midtown. We were kind of trying to figure out what the next fund of our business will look like. Probably spent the first 30 days trying to realize like what's up and what's down. And then we went out to market and found a large institutional investor that kind of backed us and gave us a lot of funding. And that was great. Kind of took our business to the next level. And fast forward, we're $1 billion later, here we are. But it was at that time where like there was literally no liquidity. Everyone was terrified for obvious reasons. So if you could just find people that had capital raised and ready to go, that was like the best thing ever.
Wow. And is it a fair question, and can you answer the capital that you deploy is largely in investor capital, or some of it the Fisher brother, your balance sheet?
So Fisher does have investments in some of our vehicles, not all of them, but most of it's third party institutional.
Yeah, institutional. Are there family offices, institutional family offices?
There's some family offices as well, but I would say it's mostly like pensions, endowments.
Yeah. Full disclosure, I'm going to ask this question, but I was a founding shareholder of Signature Bank.
Sure.
And can you talk about and I sold it 10 years ago, so I didn't see the ugliness, from a shareholder perspective. But how did that all there was a Signature Bank, I know, had a lot of big real estate um, uh, developers, investors in New York. I know a lot of them. What was the workout like? Yeah, did you? I'm just wondering, sitting on the sidelines, seeing how, okay, where'd everybody go? I know it got taken over, but did the real estate developers and so forth, did they scatter to the wind? Did they go to a particular bank? How'd that all work out? Do you know?
I believe they all probably went to JP Morgan.
Yeah,
I had to take a guess. I remember when all the banks were failing, and well, not all of them, but some of the banks were failing in March. We actually run a list of every single account we had, and as you can imagine, it's a lot of accounts, not including our fund accounts, but the property level accounts on our end. And we had First Republic, we had Signature, and some of them. And that weekend, I think we all started moving money to the PNCs, the JP Morgans of the world, and that happened within a week.
yeah,
Not because like we were scared. I mean, we had to protect our investor capital, right? And
exactly.
even
Yeah.
our investor capital it's capital at the property level. So everyone went to large institutions like overnight. It was very quick. Um, I don't know the specifics of Signature Bank. I think a lot of the banks, including them, New York Community Bank, they all had pretty big multifamily loans in the city. And like, I'm not sure how familiar you are, but New York City multifamily, they passed regulation changes 4 or 5 years ago. That effectively makes it impossible to raise
Impossible.
rents. Yeah,
Yeah.
it's tough. And your operating expenses are increasing, your rents are kind of staying flat. It's not a good situation. So I think they had a lot of loans at pretty low debt yields, and as rates went up, they kind of got squeezed. And some of the banks went long, longer duration assets to kind of make up for it. It was a bad recipe.
Yeah. I remember when the regulations changed, there were some people that had just bought the multifamily, didn't see it coming, and they had to give the keys back. They just said, we're
Yeah,
done.
yeah. You can't do anything. Like
Yeah.
it's the tenant laws here are very favorable in New York. Um, you just literally can't do anything legally.
Is there any talk of that changing anytime soon, or are those laws just still locked in?
No, as dysfunctional as the U.S. government is, I don't know New York State's any better.
Yeah. And of course, you get the headline news about the squatters in Queens,
Yeah,
which it's true. I've seen it happen. And
I've got multiple stories for you that are probably better served over a
yeah,
beer.
for another time. The thing that I learned is the only way to thwart that at the onset is to call the police and say that you have somebody robbing your house. You can't say there's a squatter, because then you're toast, right?
Yeah,
Yeah,
maybe that works.
that's right. Maybe.
So I'm going to change topics a little bit because I know we're coming up on time here, but I would regret it if I didn't try to pry a little bit more into history. I'm a bit of a history book buff. I always try to see, track backwards of where things started. You said the Fisher family is 108 years in real estate, but how did they get into real estate? I mean, of course, it was less expensive in New York back then, but that's still a substantial amount of money for them to take on the amount of real estate you're talking about. Do you know the history at all, or do I need to go research that offline?
No, I do know some of the history. I believe they start off as bricklayers in Queens. So the family originally, I believe, immigrated from Latvia, one of the Baltic nations, and came and started off as bricklayers in Queens, started building homes and multifamily projects. And, Martin Fisher was the original founder, I want to say. And he had two younger brothers that came to join him. Not Arnold, Larry and I don't believe Zach joined him. And then they started the business, kind of took off ever since.
Wow, what a story! Bricklayers and become create such an empire. It's amazing.
It's very impressive.
I
It
was
is
looking on their
impressive.
website and they have a beautiful historical snapshot of, when it started on all the different lines of properties. And it's kind of like this nice walkthrough of the last century in really big builds. It's really cool.
Yeah, they built some big changing buildings in New York City. I mean,
the skyscrapers, if next time you guys go to New York, stand in front of one of the Fisher. I mean, it is epic. The skyscrapers you guys still have. I mean, it's just amazing.
Yeah.
And there are, I know of a half dozen stories, immigrants coming, starting from scratch, the Lafracs, right?
Yeah. Very
It's,
similar stories for all of them.
yeah. A.B. Rosen, right? It's just crazy. And then what you don't hear about is the people who own the land leases, because they've been just clipping coupons for 100 years, right?
Yeah, and there's a decent amount of those. Although there's, I think, two big families that had the patriarch pass away, and now it's going to the third and fourth for the kids.
Yeah.
And those empires are basically getting settled now. But it's happening real time too.
Yeah. Fascinating stuff.
Well, Sebastian, before we let you go, I would really love your insight. If you were talking to a family member, whether that's a son or a nephew or a niece, and they were getting into real estate and they wanted your take on the best place to focus their time and the biggest monsters to look out for, how would you answer that question?
So starting off, I would always tell people start working for a brokerage firm, getting your feet wet and learning every single transaction you possibly could. Because you just want to see deal flow and you want to be in the office till late at night eating dinner the first couple of years of your life. I mean, that's truly what you want to do. That's how you kind of make in this business. And you want to go to a place that sees lots of deal flow so you could see the intricacies of the entire business. And then you really have to go and network. And this is still a very relationship based business. I don't think AI is really going to be taking over real estate, at least at this kind of
That's
level.
not going to happen.
No, it's too relationship driven, right? And you're raising capital from other people that want to see you, and they're not giving it to a computer. There's too many nuances in this entire industry. So work hard, look at a lot of deals, and network as much as possible. The more people you know, the better it will be towards the end of your career.
Yeah, I love that.
What to look, I think you said what to look out for is the last thing.
Yeah.
Man, that's a tough one. I guess don't overlove her. I think
Don't
that's probably,
overlever.
probably the theme of the entire last couple of years.
So one last question, because it
Sure.
came in while you're speaking. What's your ideal transaction? What would you love to see come across your desk, and what would be underwritten the fastest with you and your team?
Oh, multifamily all day long. Can't go wrong with multifamily. Easiest asset class in the world. There's a million comps. It takes 10 seconds to underwrite, at least in today's world. Hard to get hurt, right? You don't really lose your shirt on a multifamily project if you don't overlever it. That's the easy answer. I think where everyone's going to is the niche assets, right? So it's like your indoor outdoor storage, your data center plays. I think the world's drastically changing towards those. At least they're becoming more larger parts of people's portfolio. So it'll be interesting to see how that kind of plays out in the next couple of years. I wish we were there kind of earlier on those assets, because I do think the world's going to change much more for those types of deals.
Yeah. And if I dive a little deeper on that ideal scenario, so it's multifamily, what state, city, what deal size? I'm just trying to really get an idea.
Sure.
If I talk to an operator, a very large operator, it sounds like, who would be your best case scenario?
I'm going to have to say New York, purely because it's impossible to build new multifamily going forward. So if you could hold on to a nice asset today, your rents will go up a lot faster than inflation. As long as the laws don't change again for the worse, New York multifamily should be a great investment going forward. Personally, there's no supply, so I don't know how you lose that game.
Got it. And that would be
Does
the
that hold true? I'm sorry, Christian. Does that hold true in the context of what you said about tenants and the laws regarding tenants in New York?
So the new laws for affordable housing, new laws for multifamily housing in New York, the market rate units were not subject to the rent stabilization laws. So that was the key difference in those transactions. The affordable units are always subject to rent stabilization laws. And those are just what they are. As long as your market rate units are free and clear of those, like you have a lot more flexibility in terms of raising rents. Um, you know, they're all very unique programs, kind of depending on what year you've kind of gotten there and what program it's under. Um, but yeah, I mean, they could always change those too. So
Yeah,
Sounds
super
great.
helpful.
To
Yeah.
know.
Yeah, I appreciate you spending some time with us.
no problem. Thank you all.
Yeah, Sebastian, that was great. Super appreciate it.
It's a pleasure being here.
If it's watching, thanks so much for joining us.
Yeah.
Thanks, everybody.
So you're gonna close it up, Julie?
Yeah, we just want to talk, and if you need to drop off, you can, but I just need to give them a couple talking points from today. So obviously the shakeup in S&P, the downgrading ratings, and then how would you summarize what else we've talked about? Interest rates and how today's interest rates affect CRE sales, markets, values. How do I?
Yeah, that's all good. Sure. Yeah.
Before we do so, Sebastian, is there anything else that you think we would like to cover? I appreciate your time on here, and we have the ability to add anything in.
No, I'm surprised you guys didn't go into 2024 politics.
Yeah.
How much time do you have? So, would, Kennedy just chose his running mate.
Who is it?
It's Sergio, yeah, Bryn's ex-wife.
Ugh, I just love
Um,
Kennedy. I got to work with him personally, and I just get so mad that there's like only two real options in this country because that is a fantastic man.
I think so too.
I
I
love
think
him.
that the play, it was pretty obvious, is that he's a Democrat at heart. He knows he can't win this election.
Yep.
So he's
So
pulling,
he had to deviate.
yeah, and so he's going to make that play to get back into the Democratic Party in the next election cycle. And I will admit, and I mentioned this to Michael, I'm going to have him here in Park City to ski with a bunch of my friends in a few weeks.
Well, that's awesome.
And yeah, I wish that there was more room for him to win, but we can get all kinds of. But I wanted to share one thing that I learned yesterday about data storage. There's businesses with storage centers for data and so forth. One of the companies that a fund that I'm invested in just landed on the moon, established their first data center to store data in the cloud on the moon. And the first customer was the state of Florida. And the first transmission from Earth to moon was the Declaration of Independence.
Wow.
So ignite your latent patriotism. We're making it happen despite of all the shit that's going on in the world.
I love it.
That's pretty awesome. Wow.
It is awesome, right?
Arthur,
Yeah.
can we bring that as the shakeup for next week's show? I think
I can have him come on the show. Yeah, totally. Yeah. Yeah. Super cool. Super cool.
Love
Yeah.
it.
That's pretty cool. So you're an investor in the company?
I'm an investor in the fund that invested in the company.
Got it.
And the fund is run by a very good friend of mine. You'll love this. His name is Hamlet Yosef.
Great name.
And Hamlet was agency, CIA operative in the Middle East. And he retired, super smart guy, great friend of mine. And this is one of the companies and he has a fund called Iron Gate. And he's a venture capital fund investing in defense technology, space tech, blah, 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 that sort of thing.
Line them up, Arthur.
Totally. That's easy. Yeah.
So
So
cool.
Sebastian, I'll when I come to New York in a couple weeks, I'll look you up. Maybe you and Ari and I can break bread.
Would love to.
Yeah.
Would love to. Please, yeah, please let me know when you're here. Drinks on me.
Oh no. You can try.
Fair enough.
Yeah. All right, guys. Thanks so much. Sebastian, again, super, super great. That was awesome. Yeah.
Yep.
Of course. Appreciate it. Thank
All
you
right, I'm off. You guys don't need me, right?
Don't need you,
You
but
need Sebastian?
but always love you.
Okay.
Nope, we're good.
Good.
Okay.
Thanks
Thanks.
so much, guys. Both of you have a good night.
Right.
All right, let me do a little wrap up. All right. How did I start out? Guests. So I'll just say in today's episode.
Yeah, just do that.
Okay.
You just made in today's episode. I think I want to get Nick to put something together where he kind of wraps that in as part of the intro. Like you can have the standard intro and then wrap in your overview of what we're covering. And then that'll transition into the, the start of each one.
It's just like a voice overview, right? With cool
Yeah.
graphics.
Exactly.
Okay, great. Okay. In today's episode, we'll talk about the shakeup in S&P's downgraded ratings for 5 different national banks, from a stable rating to a negative rating. And we're also going to talk about how investment rates are affecting residential and CRE sales, values, and markets.
Cool. Sounds good.
Okay. Boom. I didn't record, and I don't know if the other guys did either.
I'm almost certain they didn't because
I'm
we would have had to push the
freaking out.
button.
So I'm going to do a checklist, like record, tell them all the stuff, to put in the chat where to send it. So editing team, praying that the sound is decent. And if not, we'll just redo it.
We can get them again.
Ay, ay, ay. Yep. Thank you,
Perfect.
Christian, for being awesome.
Thank you, Julie. Talk to you
Okay.
soon.
Take care. See you.